Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back here in home studios today, right in the middle of June, halfway through the year. NBA Finals going on, summer vacations. The Reds are trying to hang in there here in Cincinnati, and mini camp for the Bengals is wrapping up without their first round draft pick signing his contract. Definitely not a sports program here today, but we like to have some fun. And I got a lot of news to get to today as well. So we won't spend too much time kicking things around here today, but NBA Finals, I know, is your jam. No pun intended at all. I'm going with
Right.
the more local to the Cincinnati squad here, the Pacers. I think that they'll take it home, man. But you got any thoughts for us here, real quick, before we get to more action?
It's kinda hard to count them out. I saw a stat where when, games are tied 1-1 in the NBA finals, the game 3 winner goes on to win it like 38 or 33 times to 8 times. So, definitely looking like it's in their favor, but I think the Thunder might win game 4, and we'll see a 7-game series is what I'm hoping for. They've all been great so far. There haven't been any blowouts. The Thunder kinda looked in command the last game they won, but it still, I think, was only like a 6-point game or something like that?
Well, what I like what you started with there is you went back to history, historical data
Yep.
to help you understand what the probabilities of success might look like
Right?
under those circumstances, which is a perfect segue
And,
here to
as I've learned from you, previous success is no guarantee of future results. So that's why I said the 33 and 8 because
that's
they might,
right.
you know,
Never know.
you never know.
But that's right, man. That's the way to look at it. You're putting yourself in the proper perspective as opposed to letting your emotions dictate. Oh, this guy's playing great. This guy's not on this team, and etc. This coach is better.
Right.
No, those are emotions. Those are feelings. Let's look at what history has to say,
Yeah.
and that'll put things in proper perspective. So, couldn't have asked for a better segue. I didn't even ask you to do that. It just kind of happened naturally. So
Well, I didn't
that's
ask you for the NBA jams pun. I appreciate that. So,
yeah. Although with the extra growth that we've had here this year and going into next year, maybe we can swing one of those NBA jams kind of things, like the arcade video game, just throw it in the office. That'd be pretty cool. But
don't
I
you tempt my
digress.
emotions.
Let's talk about not getting work done.
Oh
Uh,
god.
we like
Can you
having a
imagine if we
golden
had
tee
one of
in the
those?
office. I'm
Oh,
like, no, we can't have that.
yeah.
But yeah, welcome to the show. Perfect segue. If you're new to the show, please like, share, subscribe. Welcome. You're in the right place here. We've been doing this for 4 years now, over 1,000 videos, I believe, if I'm not mistaken, as on the YouTube platform. We're also on Spotify. And the reason for the show, the reason why we've had the success here that we've had, is because we bring attention to something that I just don't ever really see happening in the news at all. But I do encourage the news to start to do some of this stuff. And what this is all about, the Shepherd Wealth Management Podcast. We understand that human beings make a market, and we also understand that human beings have smartphones. We also understand, thanks to things like behavioral finance and psychology, that we're all hardwired with a lot of emotions. But when it comes to investing, there are two at play, that is fear and greed. What we've learned from this study called behavioral finance is that human beings, investors, feel losses emotionally twice as much as they'll feel good about making almost any amount of money. So we are risk averse by nature. We're trying to avoid losses. And the news understands this probably better than any other company on the planet, in that they're trying to increase their ratings. The only way to do that is to get their audience engaged, which is typically the reason why you see headlines that are more fearful, because it placates those human emotions I just referred to, and you're twice as engaged because you feel losses twice as much as you would feel good about making a gain, according to behavioral finance. And that is a problem for the individual investor. The best investor of all time, Warren Buffett, in my opinion, maybe others think somebody else is better, but in my opinion, Warren Buffett is the best investor of our lifetime in this generation. And he simply said this: the number one reason individual investors do not achieve the results that they're looking for consistently over time is because they have no control over their temperament. In other words, they have no control over their emotions. So, how do we do that? The news is giving us scary headlines because they're trying to increase their ratings. There's nothing wrong with that. They're a for profit business. That's how they make their money. I have no problem with that whatsoever. But what they leave out is say, yeah, this is something to be concerned about for X, Y, or Z reason. What they leave out and what this show is all about is saying, yes, this is something that needs to be brought to our attention. Thank you. But by the way, you left out that we've been through something very similar to this 17 other times in the course of the last 75 years. And here's how the market played out 6, 9, and 12 months later. Here's where the sectors that did the best or the worst over the same period of time under very similar circumstances. And it doesn't guarantee anything. Past performance, as you said, as is no guarantee of future results, and investing always involves risk, including risk of loss. And if we're trying to get control over our emotions, well, what we found a lot of success with here for our customers at Shepherd Wealth Management over the last 4 years is that we bring this to their attention regularly. It puts things in the right perspective. It helps us understand what the risk and reward is for decisions that we're making. Again, it's not a guarantee, but it does put it in the right perspective because that data is just data. It doesn't vote. It's not a unbiased or biased piece of information that you might have to filter through in the news. Some of it's very biased, some of it's very unbiased. But instead of trying to filter through that, let's just see how other human beings have behaved under very similar circumstances. And there's only one thing that's happened in the course of history that I cannot find a precedent for, and that was COVID. There's never been another period of time in history that I'm aware of where you can shut down the global economy for nearly a couple of years and compare that to what happened during that time. But over pretty much anything else that you're going to hear in the news, there's definitely a precedent for it. Again, doesn't give you a guarantee, but it does help you control your emotions because it puts your mindset in the proper perspective. It'll help you understand what the risk and reward is. And once you understand that, now you don't have to worry about those emotions. It's just data. You can start to make intelligent decisions of what you might want to buy, sell, or hold, what sectors you're going to overweight, etc. And that's what this show's really all about: is getting to the nitty gritty details that the news is bringing to your attention, but also marrying that up with historical data. And then from there, we can start to make some intelligent decisions. So, a lot of success for our customers this way. This process is repeatable, has very little to do with me or my business partner, John Ashcroft, being the super smart, having to be the smartest person in any room that we walk into. No, I mean, that's just unreasonable. But we can lean on this sort of process because it does work consistently over time. Because the one thing that we can point to over time when it comes to investing, a lot of stuff you can never control. But the one thing that is true across all periods of time of investing is that human beings make a market. And I think most of us would agree that human beings haven't changed all that much in a couple thousand years. So that's what this is all about. We got some data to get to here today, Ez, and some reaction from market pundits as well as the market in general. So I am ready to fire the proverbial pigskin, as they would say.
Go for it, Mox. You can do it.
As a Varsity Blues reference for those that are not familiar with that. So CPI came out yesterday, and this is headline inflation. CPI came in at 0.13. Economists were expecting 0.28 month over month. So this literally came in half, basically a little less than half of what economists were expecting. And that is rare. And on top of that, or as I would say, in addition to that, we've talked about this many times. As there's a couple of things in that CPI basket of data that really drives, the inflation number up or down. The biggest component of that is shelter, ex hotels. It's literally 43% of the weighting, just right there. I mean, between shelter and auto insurance, which we'll talk about that here in a second. I mean, that makes up the vast majority weighting wise within the CPI calculation. So it came in half, but here's the cool thing. The biggest component of the CPI basket being shelter X hotel, 43% of the weighting there. I mean, that came in month over month 0.27. The prior month was 0.35. I mean, that's a big drop from a percentage standpoint, month over month, which is fantastic. And that's exactly what you want to see. So the question is this something that we can expect to continue to happen into the future? Well, again, there's not a guarantee. Anything can happen, of course. But right now, the data is showing that there's about 500,000 more homes for sale than there are buyers. Well, anybody that's taken any economics class whatsoever, when there is more supply, homes for sale, than there is demand, what do you think might happen? The prices are going to come down. That is disinflationary. This is the biggest component of the CPI basket, 43% of the calculation. And by the way, it's 4 straight months of inflation falling lower than economists expected. That is very rare. Now, to continue the CPI discussion, specifically from a shelter component perspective, and the reason why we're focusing on this, if you haven't caught on already, is this is the biggest part of the weighting within the CPI basket. Just to give you some historical data on this, in March of 23, the CPI shelter component was at 8.18% year over year. Today, it's at 3.86. Okay. The 20-year average of the CPI shelter component is 3.11. We need it to settle right around 3.11 or lower. But I mean, we're damn close. I mean, this is within spitting distance. We're talking about another month or two. And then we should be right there, which is fantastic. Again, the biggest component of the CPI basket being shelter. Now, with this data that came out here today, the probability of Fed rate cuts also jumps. So we got a big Fed meeting next week. I got some stuff to say about that. But the probability of a rate cut jumped from 1.6% this morning. But after the data came out, it jumped to 1.9%. So let's just call it 2 rate cuts, which, by the way, that's exactly what the Fed had it set up in their dot plots, their summary of economic projections right at the beginning of the year. Now, they haven't cut interest rates yet, of course, but before I get to next week's Fed meeting and my perspective on that, I did want to go over the auto shelter component of the core CPI. So, core CPI April 2025, we got housing representing 55%, auto, insurance, and new and used cars. If you combined the new and used cars with auto insurance and housing, that's 76% of the CPI basket calculation. I mean, that's really all you need to know. And those things are falling, as I just described there. Um, I don't know how a Fed governor could look at this kind of data, and they're supposedly data dependent, right? I mean, as you know, this, I think our audience knows this since we've been covering this for 4 straight freaking years. Every Fed meeting is like a little Super Bowl for us. They've said data dependent over and over and over and over. And you got 4 straight months of falling inflation. You got more homes for sale than there are buyers. CPI came in half of what it was supposed to be, according to the experts. And rate cut expectations jumped. I know that the Fed chairman, Jerome Powell, is not one to surprise markets, and markets are not pricing in a rate cut at all next week. So I am very skeptical that he'll have the intestinal fortitude to do the right thing, regardless if that would be a surprise. By the way, that would be a positive surprise. And it's 25 basis points, by the way, that we're talking about here. I know that the president wants, a full percentage cut. I mean, that's just not going to happen. Um, you could get there over the course of the remainder of the year. I mean, I think that that's reasonable as long as inflation numbers continue to come in the way they are. But as long as that biggest percentage of the basket of CPI is falling the way that it is, I don't think that it's too much of a stretch to think that this is likely to continue. Which, by the way, core CPI year over year is currently at 2.7%. The median right now, the median CPI component is at 1.49%, which is way below what the Fed's 2% target is. Now that's a median. It's not overall, but if you can read through the data here that I'm providing from a shelter component perspective, as long as that continues, and why would we expect that to change? You got 500,000 more homes for sale than there are buyers. You don't need to go to MIT economics class to understand that when you got more supply than there is demand, the price is going to come down, and they're going to continue to come down as they have all year long. And if it's the biggest percentage weighting wise, by far and away the largest, I think that this is likely to repeat itself. Therefore, if you're an unbiased Fed chairperson, right, you're not looking at your political views, you're not looking at anything else other than the data that I've just described here, because that's what you do. You're an economist. You're not supposed to, seriously, that's for behavioral finance. If you want to understand feelings and emotions, that is behavioral finance 101. I can have that conversation with anybody all day long. I love it. It's fascinating. But if you're just an economist and you're a banker, Fed governor, you're looking at data just like this, just what I described. And how can you look at that and possibly like twist your mustache, like, you know what? I'm really not sure. I can't be for certain. And you're an economist, by the way. You're never for certain. There's always risk to not doing anything, doing something, raising rates, lowering rates. There's always a risk. But if you're worried about your credibility, which is what we've heard for 4 straight freaking years, well, the Fed's credibility is at stake here if they don't blah, blah, blah from whatever the financial pundit on CNBC or whatever you're getting your financial news information from. It does not make any sense. It seems very biased to me, because the numbers are screaming that it's time to start easing policy. Why would you restrict the US economy when it's humming along so well with maximum employment and price stability? 4 straight months of falling inflation. You're real close to that 2% target. And by the way, the Fed themselves last summer, roughly a year ago, maybe a little less. I know that we covered it. And they said that they do not need CPI to be at 2% before they start easing rates. So it's time. It's definitely time. But again, it's not priced in the market. Fed Chair Powell is not one to surprise the market. So I wouldn't get too excited about a rate cut coming up next Wednesday, which is the Fed announcement. They meet on Tuesday and Wednesday of next week. On Wednesday at 2 o'clock, we'll know what they decide to do. They'll have a press conference at 2:30. It'll probably last about 30, 40 minutes, something like that. And the market will certainly be moving based on their decision, but more importantly, their words when they start answering questions. And they always start out that meeting, by the way, with we are squarely, all of us here at the Fed are squarely in line with serving the American public. Well, let's serve the American public instead of servicing whatever bias or whatever's holding you back from looking at this data. You can't even articulate it. All that you've said so far this year, Fed Chair Powell and Fed governors, is that you don't know what the impact on inflation and jobs might be given the policies coming out of the White House. It seems to me like you just don't like the person making the decisions in the White House, because the decisions that the news said was going to cause the US economy to spiral into some black hole that we'll never get out of, and we're all of a sudden going to be a third world country and US exceptionalism is now gone. None of that's happened, which is why you've seen the recovery that you saw in the stock market here over the last several weeks. And we've called that out. There was nothing in that data that should have caused the fifth fastest drop in the S&P 500 since 1950. And if you missed that episode, that was a damn good one. That was about a month ago, if I'm not mistaken. So go check that out on YouTube. So we have University of Michigan data coming out tomorrow. This is a soft data survey where they're asking investors, other human beings that participate in the market, how do you feel about the economy, inflation, all this different stuff. And you could actually understand in the data, based on how it's collected, where the bias is. So just so you know, the inflation expectation, if you are a Republican investor 1 year from today, is 1%. That's what they're saying. Now, if you are a Democratic investor, you think inflation 1 year from now is about 9.4%, which is, even higher than what it was a couple years ago when we were really dealing with this stuff. So you can see that there's a lot of bias and emotion. That's what this is. This is an emotion going on here, depending on your perspective and your feelings about some of the decisions that are being made. I'm not saying squash your feelings or it's not important to you or You're allowed to feel, everybody's allowed to feel however they want to feel. That's not the point. But if you're trying to make investment decisions, you got to have a way to stop that and remove that from your investment process. That's why we need to look at historical data. And if you look at this University of Michigan data, it's 3-2 respondents between Democratic versus Republican respondents in this survey. So it's certainly skewed, right? And you're going to get this information tomorrow. Hopefully, it's a positive read, but it's a soft data survey. Again, the questions are more about how do you feel about the economy, inflation, et cetera, et cetera. And it is an important piece of data, but I think it's starting to lose some of its luster, given the fact that we can break it out into um, your political views as well. And that is something that I'm looking forward to taking a look at, certainly, but not going to be using that to make a lot of decisions for customers with. That's for certain. All right, shifting gears here just a little bit. We've talked about this countless times on this podcast. The key to achieving consistent long-term investment success is definitely removing emotion from your investment decisions. It's not our opinion. This is definitely the belief of, in our view, again, the greatest investor of all time, Warren Buffett. And according to him, quote, "If you can't control your emotions, you can't control your money," end quote. Moreover, as we've talked about endlessly, science has proven this to be true. Um, and as I've mentioned, countless times again, behavioral finance shows that investors and other humans feel losses twice as much as they feel good about making money. But what this is called is loss aversion. Our approach here at Shepherd Wealth Management to making investment decisions on behalf of customers across the United States begins with understanding how other humans, how other investors behave in similar market circumstances. And this obviously helps us remove emotion from our decision making process because that data is just simply data, does not vote, does not have an opinion, just is what it is. And this helps put the market into proper perspective, as we talked about. We don't have to try to filter out information from Barron's or any news article or anywhere else to understand if this is truly biased or unbiased information. And once we understand the risk and reward and the outcomes that may happen, again, it's not a guarantee. Based on that historical data, now we can focus on these sectors of stocks instead of everything. So instead of looking at the whole world of stocks and bonds and ETFs and mutual funds and whatever else that floats your boat, once we understand how other humans have behaved, what the risk and reward is for the different sectors within the S&P under those similar circumstances, now we can focus on just a handful of couple sectors, couple stocks within those sectors, et cetera. And then we can finally build an asset allocation, a mix of stocks, bonds, and cash that fits the risk and reward characteristics of the individual client. Of course, this doesn't guarantee anything, but the process seems to work consistently. Now, as of the end of May 2025, this process, net of fee, has led to an average return across all of our client portfolios of 13.19%. Over the exact same period of time, the S&P 500 was only up 0.74%. That's a lot of value is what we would call that. The difference between this average client performance across all portfolios, comparing that to the S&P 500. And why do we compare it to the S&P 500, you might ask? Is because the majority of our clients, about 80% or so, are charging us with growth. And their definition of growth is outperformance. Now, they understand that this isn't something that is easy to do. They also understand that it's very difficult to do consistently. But thankfully, the process that we've implemented isn't something that I created out of thin air. You can do this for yourself. You just have to find the time and the willingness to drive to go look at historical data. And if that's not for you, well, thank God that there are places just like Shepherd Wealth Management across the country, across the world, that are here to help. Now, some are certainly better than others, like just like some doctors are better than others. Which brings me to a kind of a metaphor, if you will, as um, if we're going to go get a checkup from a doctor, right?
Yeah,
And the
got to at
doctor's
our
like,
age. Got to at our age, buddy.
Yeah, man, I'm getting up there a little bit now, even though I'm a pretty healthy guy." You go to the doctor, right? And let's just say doctor asks you a question like, "Hey, how you feeling?" I feel pretty good. Don't feel sick. Don't feel achy. Just feeling good. You get your checkup, and the doctor goes, "You know what? I want you to come back next month. I want to do another checkup. I know everything was clean. Everything looks good. You said you're feeling good. That's awesome. Sounds like your diet's good. Doing a little bit of exercise, but we need to make sure that you're not sick, and we really want to make sure that you don't have cancer." You'd be like, "All right, well, at least you're looking out for my best interest, I guess." So you show up the next month, same thing, feeling great. Doc's like, I'm not sure. I got to check again. Next month, same thing. Next month, same thing. That is exactly what's going on here with the Fed and our economy. The Fed is giving it a checkup roughly every other month, and the market's checked out flying colors. Perfect blood count, very healthy, heartbeat's good, no problems, sleeping well, eating right, and exercising. I got to keep checking. Got to keep checking. But the problem is you're not you're basically saying you're healthy, but I can't be for sure. So I'm going to keep prescribing you medicine, right? And the medicine from the Fed is, even though they haven't done anything, they've been holding rates steady. Their medicine is tight. They know they're tight. They should want to be at neutral. Neutral being a Fed funds rate that's not stimulating the economy but not holding it back. They should want to be there all the time, just like you and I should want to be healthy all the time. We might need checkups, but that's where we want to be. That's ideal. But for whatever reason, they're wanting to inflict pain, providing medicine. For what reason? Other than the fact that they're uncertain, just like in this example, the doctor might be uncertain, even though every time you go in for a checkup, everything looks great. It's not a very good doctor. I don't think anybody would want to continuously show up for a checkup and checkup and checkup. Eventually, is you're not looking out for my best interest, man. You're looking out for something else, and I don't know what that is, and I don't like it. And that's just the perspective of those on the other side of the Fed aisle, right? If you want to understand both sides of the aisle, that's probably the best way to look at it. If you're not somebody that's a financial savvy person. Now, getting back to market stuff here for just a second, even though there's a lot of people out there that are very positive on the market. When I say a lot, there's not that many, especially when you turn on the news. We have been consistently positive, and that positivity, along with the process, has certainly delivered a service and performance above and beyond a lot of expectations for many of our customers for 4 years. And we're very thankful for that. I have so much thanks and admiration for all the customers that decided to turn over their hard-earned savings to Shepherd Wealth Management and charge us with some pretty fantastic goals that they're asking us to achieve on their behalf. And we're not perfect, but we do believe the process has led to a product performance-wise that's consistent and a service that is difficult to match. But during our servicing of clients, we go through quarterly reviews. We drive around, we fly throughout the country. We meet with them, sit down, sometimes over the phone, sometimes on Zoom. And even though we've delivered performance and service consistently over these 4 years, and by the way, I remind them over the 4 years, those have been around that long with us anyway, we've been through a lot. You've been through 40-year high inflation. You've been through a couple wars. You've been through presidential change. You've been through a lot of stuff. I can go on and on. But many customers are still extremely skeptical about not just the stock market, but even our outperformance. As I just mentioned this year, they're like, wow, this is awesome. But they're kind of like waiting for the other shoe to drop. Ironically, this is a bullish indicator. After all, a large share of investors are positioned for losses. I'm going to talk about that here in a second. The pain trade, then, in our view, is for stocks to continue to rally on top of all the really good inflation data that I just provided, on top of the really solid unemployment data that has not moved hardly at all, on top of some of the best earnings that we've ever seen, and earnings estimates have increased. Yet investors across the country, not just ours, but everywhere else, I'll speak to ours, are very skeptical. They're happy with the results, but they're very skeptical about the market right now, mostly due to headlines. They don't have a specific thing that they're pointing to other than what they've heard and are regurgitating during these meetings, which is a big reason why we want to sit down with customers. I want to understand what their perspective is and help them steer that perspective in the right direction so that they're not losing control over their emotions and making knee jerk decisions. Matter of fact, we wonder if the next move for stocks is a melt up rally, which would cause a sharp rise in stocks, forcing short covering. And this is sometimes referred to as a face ripper rally, as I know you like that.
I do like that. That's my new favorite term.
And we think that probability is likely. So, first of all, the short covering, for those that may not be familiar with that, institutions, hedge funds are almost more short today, meaning that they're betting against the stock market. They're wanting stocks to go down. That's what short sellers are. They're hoping for the position that they're in, they're shorting, is to go down. So they're short the market almost at extreme levels that they never had before. So as the market were to rally up, if I'm right, and we get this melt up rally, well, that's going to force institutions like hedge funds to buy shares to cover the short loss. That's what they have to do. Now, obviously, that buying of shares is going to cause a bit of a frenzy and therefore a market rally or melt up. So that's one reason that we think that that could happen. Reason number two, the New York Stock Exchange FINRA margin debt, which is publicly available information, shows 3 consecutive months of margin debt declining. This is not a sign of a market top, folks. Usually, this would happen as margin debt increases. So let me explain. When there is a market top, historically, again, not a guarantee, but historically, market tops are a sign of margin debt peaking, meaning that investors, both retail and sometimes institutions, are borrowing money from a broker, Fidelity, Charles Schwab, whoever they're doing business with. They're borrowing money to go buy stocks. And the more margin they take, it's a sign that investors are extremely bullish, right? And that's generally when you see market tops. At some point, people get overextended, the market gets overextended because of all that borrowing and buying of shares. And then you typically see some sort of correction or pullback. Well, that's not happening right now. 3 consecutive months of margin debt declining, that is not a sign historically of a market top whatsoever, which is a good thing for those that are positioned for growth. Third reason we think that there could be a sharp rally. Again, as this is your favorite measure, the AAII net bull bear sentiment remains historically negative. Again, investors are feeling nervous, but the hard data, such as inflation, unemployment, corporate earnings, are positive and very strong. So, this is a good thing for those that are positioned for growth. Fourth reason, there's a significant perception gap. The market itself is telling us there is more clarity than economists believe. I'll give you a few examples. Number one, tariff uncertainty and the negative impact on the economy is more benign. You're seeing it in the inflation data. Number two, risk of surging inflation is more of a consumer economist perception than reality. Again, the news has talked about how these policies are going to spike inflation, cause unemployment, and we're just going to go into this spiral black hole of an economy. We should all really just curl up in the fetal position and wait to die. You're not seeing that. You're seeing in the soft data, like the University of Michigan survey data, depending on your perspective of things, on how you feel. That's what the questions are. How do you feel about X, Y, or Z? But you're just not seeing it in reality. You're not seeing it in any of the hard data. Third reason, there's a spillover to bonds, and US dollar risk are smaller than American exceptionalism is over. In other words, the bond market's not freaking out. Neither is the US dollar. And those are pretty good indicators of things like recession. The bond market typically sniffs that out way before the stock market would. I'll give you a fourth reason why melt up is potentially in the cards here. Interest rates are falling. Even though the Fed's not cutting rates, rates are falling. And the unemployment rate has not moved. Again, the Fed has a dual mandate. Their mandate is maximum employment, check, price stability, check. We should be cutting rates, folks. It's 25 basis points. Nothing's going to happen. Okay. Other than the market will like it because it's not priced in for the Fed's meeting next week. Fourth reason, the job market is strong. 139,000 private sector jobs reported this week. Economists were looking for 130,000. And last but not least, there is $7 trillion still sitting in cash. This is the most hated bull market that I've ever seen in my history here in doing this job, which goes back, more than a decade now. That's keep in mind that is more cash, $7 trillion sitting in cash. That is more cash sitting on the sidelines that's missed the full recovery after that major sell-off that we went through. Again, the fifth fastest drop in S&P 500 history from mid-February all the way through about the midpoint in April. Over the course of that 6-7 weeks, I mean, that 7 trillion was still there. It could have bought stocks. It didn't because they were so fearful. They didn't have the right perspective. They weren't thinking, what does history have to say about similar events like this? It was the fifth fastest drop. There were 4 others that were worse. I'll rattle them off real quick for those that missed the show last week. The worst was Black Monday, 1987. Market was down. S&P was down about 22% in one day. By the way, the market finished positive that year. Most people forget. There was a currency issue that spiked a lot of that. There was some hard data supporting stocks falling. Happened twice in 08. We know what happened there. Banks got too greedy with their loans, and banks that have been around 150 plus years or longer went to zero. All right, that's a lot of hard data there. Unemployment spiked a ton during that as well. The fourth was COVID. Okay, we've never had a precedent for that, where you shut down the whole global economy. Markets had a lot of reasons for that sell-off as well. Of course, markets were really good that year, but that was a major drop in markets. This was the fifth fastest, what we just went through. And there were no hard data reasons at all. It was all in the soft data surveys, University of Michigan surveys. And the Fed didn't help. The Fed admitted, yeah, it's not in the data, but we think it's coming. They were basically saying the same thing as all the, or the majority of the consumers in the soft data surveys, like the University of Michigan. And that's 7 trillion sitting in cash that missed all of this. Why? Is because they were allowing their emotions to dictate their decisions. If they had this kind of information at their disposal, it would give them a proper perspective, because those 4 times where the market lost more faster than what we just went through, 12 months later, in all 4 instances, the market was positive. In other words, there's a 100% win ratio. What is the reward for taking on that risk? If you were to buy in the 5th fastest drop of all time, if you're a long-term growth investor, there really isn't any historical risk to buy. But there needs to be a reward that satisfies you to make that risk, because again, it's not 100% guarantee. Anything can happen. Well, the average return over the next 12 months in all 4 of those instances where the market sold off faster, the average return was 34%. That's the kind of information that puts your brain in the proper perspective when everybody else is calling for the worst things to happen. That allows you to say, okay, well, what did the best? Well, when the market loses that much, you can't really go too far wrong. But let's just make a comparison to the first Trump administration, when tariffs were really the first time brought to the public as a policy tool to drive an economy. We haven't seen that in freaking 100 years. McKinley was president last time, right? 2018. So I understood why the market had some real issues with that at that particular point in time. But I don't understand it so much today, because under that decision-making process, technology was the best performing sector over those first 4 years of their administration, up around 140%. By the way, that got whacked the hardest during that 5-week sell-off. That's what we bought the most of for our customers, which led to this significant outperformance that we talked about. And again, this has nothing to do with me needing to be some sort of super genius with like 75 screens and monitors all over the place with charts and stuff that you see. That's a bunch of BS, man. It makes you look cool, I guess. Might make you feel good. You got all these monitors. You're like, oh, this is kind of cool. It means nothing. The only thing that matters is the process that you're implementing to get the results that you're looking for consistently. Anybody can hit a home run one year. I mean, I'm sure there's a ton of home runs hitting every Major League Baseball batting practice. You don't get to go to the Hall of Fame for that, though. So let's get a process in place that Warren Buffett would be proud of because it will lead to consistency in your results with a lot less stress. Who wouldn't want that? That's exactly what we're here to help out with. And if this is something that is intriguing to you, please like, share, and subscribe to Shepherd Wealth Management Podcast. If you are a client, a recurring client, thank you so much for the opportunity to work with you. And please share this information, this podcast, with your friends, family members, and coworkers. It's a great gift. Certainly can be a lot of rewards for that as well. And I'm sure you'll get maybe even a nicer gift from them when it comes time for your birthday or holidays. So we certainly appreciate all of that and the growth that's come along with doing shows like this and sitting down with customers regularly. We look forward to doing this again in about 2 weeks. This is a show that we try to do about every 2 weeks. So we get this back on the calendar here, probably either before 4th of July or after. We're not sure just yet. Obviously, there's a lot going on this time of the year. But check us out on YouTube and Spotify. And of course, we have a brand new website. You can find out all the information about our firm, myself, my business partner, John Ashcroft. And thanks to Ezra and some other folks, they helped out with building this thing out. It's absolutely beautiful. We're very proud of it. You can go to shepherdwm.com and check out all that good information. And if you have some questions, some comments, like to schedule a meeting, all the information is right there for you to get a hold of us, including links to things like our YouTube podcast. And as I mentioned, there's a whole bunch of them on there. So you can filter through and check us out. We appreciate it. And we'll look forward to this again in a couple of weeks. Hope you guys have a great rest of your Thursday. And we'll catch you on the flip side. Take care.